Nothing can stop me. I'm all the way up. All the way up. I'm all the way up. I'm all the way up. Nothing can stop me. I'm all the way up.
What is going on, superstars? It's 𝗧𝗶𝗺𝗧 here again. Welcome back to my channel. In this video, I want to take a look at risk management when trading volatility 75 index. The truth is, a lot of times people tend to get the analysis right and they know when it is time to buy and also know when it is time to sell. But the challenge is they do not last long in the market. What determines how long you last in the market is your ability to manage the funds that you put into the market. If you can manage it well, and if you can focus long-term well enough, rather than making the highest possible profit within the shortest period of time, like over leveraging your account, you just want to make so much money at once, then you have a short lifespan in that market. So one of the things that help professional traders is having a trading plan on how to manage your risk, a trading plan on how to manage the funds that they got. And if you can manage the funds well, there's absolutely no amount of money that you will be given to trade that you will not be able to manage very well. For example, if you're starting to trade and you have $10 you start with, and you have a principle that you work with by the number of percentage you want to be risking, maybe 2%, 5%, 10%, or 20%, right? And you have a strategy that you're going to use to maximize your profits in that market. If you keep to your principle and not allow greed or hope to come in, definitely you're going to really grow that account. And if you're given a $10,000 account because you have a principle for your risk management, right, you're going to trade that account and really grow it significantly. So let me show you how to really tackle this issue of risk management on this video. Now, the first thing that you want to take note on when you're trading is you want to identify how much you truly have. You know, somebody who has $1,000 that is coming into the market with $1,000, the lot size that he uses in trading, it's different from that of someone who has $100. And the first thing you want to do when you start trading is identify how much you have. Know exactly how much you have. Then the next thing is, what lot size are you going to make use of when trading? That is the first thing. What lot size are you going to make use of? And how many pips are you going to be risking? How many percentage of your equity or how many percentage of your balance are you going to be risking whenever you're taking a trade? If you don't have a plan for this, put aside your trading strategy, when to buy and sell. If you don't have a plan, if you don't have a strategy for money management, you're going to suffer. I repeat it, you're definitely going to suffer because your trading portfolio is going to be just like a roller coaster, up and down, and before you know, you blow up account several times. Now, 95% of new traders, 95%, take a look at me, 95% of new traders blow up their account several times until they eventually quit. So the question you're going to ask yourself is, are you going to add to that 95% of traders that blow up their account, or you're going to do things differently just like the other 5%, and you're going to stay longer in the market without blowing up your account? Rather, you're growing the account gradually. I want to show you what this 5% people do that makes it really different, right, in their trading portfolio. So if you are new to this channel and you'd like to see more of my videos, because I post a lot of content like this, you want to smash the subscribe button and also turn on the notification bells. Also, drop in the comments your name and where you're watching this video from. I want to connect with you personally. With that said, let's get started. Now look at this. Let's start off with an amount of money that everybody can afford, because I know anyone who wants to come into trading should be able to afford this $10. Now, when people come to me and they ask me, Sam, How much should I use to start trading? I don't tell people any amount of money. I don't tell you $100, $200, $1,000, $5,000. I don't tell you that. I have a reason. You want to trade with what you can afford. Trade with what you can afford. That is the rule. With what you can afford. That is it. Don't allow anybody tell you, okay, if you want to get into forex trading or you want to get into trading this financial market, then you want to put like $1,000 before you really start making money, or you want to put $10,000 before you really start making money. No, that is gimmick. That is crap, right? If you don't know anything, if you don't know how to manage your trade and you come up with $10,000, you're going to blow it up. I'm telling you realistically, if you don't know how to trade the market and you're starting off with $1,000, you're going to blow it up. So the first rule for money management, I'm going to show you this. The first rule for money management, first rule, right? Let's just arrange this. I'm teaching you this live. Rule for money management. The first rule is number 1, trade with what you can afford. I take it again. Trade with what you can afford. Don't allow anybody tell you otherwise. Now, why do you want to trade with what you can afford? And even before we talk about why you want to trade with what you can afford, you really need to know what exactly is what you can afford. That is the truth. If you cannot buy a thing 3 times, some people say 2 times. For me, I choose 3 times. You really cannot afford it. If you want to buy a car and you can buy 2 times, you can buy that car twice, you cannot afford it. If you want to invest in the market and you want to start trading and you cannot fund that account twice with the same amount of money, you cannot afford it. So what does this mean? It means that do not trade with more than 50% of all you got. Do not get into the trading market with more than 50%. If all you got is $100 and you think trading is going to be your future, is what's going to bring everything, the point where you start losing out is when you fund the market with the whole of the $100 you got. You're going to lose it. I guarantee you that you're going to lose the money. Why? There are conditions. When you fund with all you got, number 1, you cannot afford to lose any money. And anyone who is playing this game and cannot afford a risk is at the verge of risking all. So the first thing is you want to come up with money that you can afford. If you can afford it, then it means you're willing to let it go. Because except a seed goes into the ground and dies, it does not reproduce more. So you must be willing to allow what you got, the seed you got, to die, right? You must be willing. I'm not saying that the money is going to get blown up. No, you should have the mindset, all right, I'm ready to invest this. I'm ready to risk this money. And that is the thing. So you want to start off with money you can afford so that you can cut off the pressures of number 1, not losing money, number 2, having a lot of needs that you want to attend to. If you have $100, use $50 and attend to your needs. And then you use $50 to trade to see if you can make more money. If you do 100% of $50, you've got the $100 again. And that is it. So the first thing you want to pay attention to is trade with what you can afford. Number 2 point is this. When you have funded your account, on every trade, do not risk all that you have in that account balance. Don't risk all. Have a percentage that you're going to risk per trade. Have a percentage, right? Have a percentage risk. Let's just keep it simple. Have a percentage risk. That is the second rule. Have a percentage risk per trade. If you keep to this, you're going to make a lot of money. I'm telling you, have a percentage risk per trade. What does that mean? If you're funding $100, you want to tell yourself, okay, I'm going to be risking 5%. If the $100 goes $200, that means my risk is going to be what? $200, 5% of $200 is $10 per trade, right? And that is it. You want to identify. Now take note, the lower your account balance, the higher the risk, because you definitely want to grow that account. And I'm going to show you more about how you can grow your small account and keeping a good risk after this break. All right, welcome back. Now I want to show you how you can grow a small account, how you can take it up from what it really is. Perhaps you're funding a $10 account, how you can take it up. After you have a percentage risk per trade, you have a definition of how much you're going to risk per trade, right? How are you going to grow up an account from as little as $10 to over $100? I want to do everything practically with you on this call. Let's say you're funding what? $10 and you're beginning to trade. Now, the first thing you want to do is decide the number of pips you're going to risk and also the lot size you're going to make use of, because the profit and loss has a formula and it requires the lot size and also the pips. So we're going to start with, this is the formula for profit and loss. If you want to trade, you just got to identify this lot size, right? You put in your lot size, then you put in the pips accumulated, right? The pips accumulated. Now, once you decide this, or once you determine every of this, you'll be good to go. So let's say you are funding $10 and you want to take this $10 all the way up, right? You want to take it all the way up. Now, you need to identify your risk. Let's say you're doing this and you're willing to risk volatility 75 is what we're trading, right? And you're willing to risk $2. What is $2 to $10? $2 is exactly 20%, right? $2 is 20% of $10. So we're starting off, look at this, we're doing a what? 20% risk. This is what you have told yourself that you're going to do. So you want to do 20%, and that means $2, right? $2, and that means $2 for a $10. So how many pips on volatility 75? What we're trading is VIX 75. How many pips on VIX 75 are you going to risk that is going to give you what? $2. And what lot size? Now, if you're making use of the minimum lot size of 0.001 on volatility 75, and you risk what? 200 pips. 200 pips, that will give you what? $2. So now you know that for every trade you're taking, you're not risking more than what? 200 pips. So if you want to grow your account and you know you're risking 20%, that means you have just 5 trades before that account gets blown up. What are the things you're going to look for? What kind of trades are you going to take? Now, what I do is when I was growing up small accounts, I take trades that are at key levels of price reversal. So you want to get in just like the sniper entry that we had in the community yesterday. And you can see the trade actually gave us a risk of just 200 pips, right? That's the kind of trades you want to take. You want to take that trade, keep the risk with just one position. That is for a $10 account. And you risk what? $2. If you do a risk to reward, that takes us to I'm just going to roll this out. That takes us to point number 3. The point number 3 is have a risk to reward target. Have a risk to reward. Number 1, you already have the trade you want to trade with the money you can afford. That's point number one. Number two, you have a percentage risk per trade. Perhaps you're risking 2% or you're risking 20%. Remember, the smaller the money, the higher the risk, right? So you're using $10 and you're risking 20%. If your account gets to $100, you may not want to risk up to 20%, because for $100, 20% is $20. So you may be risking like 10% or 5%. That is it. Now, after you do that, have a risk to reward. Whenever you're trading, keep to this rule. Your risk to reward minimum should be 1:2. So that means if you're risking 2%, you're looking to make 4%. This is the minimum. If you got a trade opportunity that's going to give you much more, very good. There are trades that will take, okay, like the trade we took yesterday on the channel, that did about 1,000 pips, and the risk was, okay, we have 1,000 pips profit. That's the take profit 3, and the risk was 200 pips, right? If you check this out, this is a 1:5. That is 1:5. Okay, so these are kind of trades that you want to be taking. 1:2, 1:3, 1:5, 1:10. Those are the opportunities you're looking out for. And you want to gradually grow the account. You're going to grow the account, but not by using a huge lot size and trying to grow it to just one trade. You're going to blow up the account, because there may be just a quick pullback and your account cannot hold it and to get blown away. And that is it. So you want to have a risk to reward target of a minimum of 1:2. It doesn't make sense risking 1:1. That means if you got 5 trades, your account is blown up. But if you have 1:2, 1:3, if the first trade doesn't go your way, the second trade will go your way, and to give you back the money you lost before and another profit. So that is how I want to do it, right? So that's risk management. So these are the 3 points. Now I'm just going to give you account size and lot size, right, that you want to make use of when trading volatility 75 index. Now, when you have 100, let's start with what everybody can afford. I'm a very realistic trader. When you have $10, you want to use a lot size of 0.001, right? Your entries should not go beyond that. If you want to grow your account and you're risking 200 pips, right? You're risking 200 pips. Let's keep our risk for every trade to 200 pips. If it doesn't go your way, fine, you take that. Now, for $10 account, you got that. For $100 account, let's say for $100, you're using this. You're using 0.005. This is one of a plan. And if you're risking 200 pips for 0.05, how much does that give? 200 pips would be $10. If you're using 0.005, that would be 200 pips will give you $10. And $10 is exactly, look at this, $10 is exactly 10% of $100 account. That is the maximum, right? So if you don't want to risk up to $10, you may decide, all right, I don't want to use 0.005. I want to use 0.2 or 0.3, and you just decide. But the truth is, whatever amount that you're putting in there, do not risk more than 10% to 20%. The truth is, everyone has their own risk that they can really put in the market. You know exactly what you want to risk. You know that. If you don't want to blow up your account, identify the amount of money you're going to be risking before you trade. All right. Several times when people blow up their account, they are taken unawares. They just come in, impulse trades. They don't have an analysis. Okay, I'm going to be risking 20%. I'm going to be risking 10%. And they just get in. And before they know it, boom, their account is blown up. So you have to prepare for it. You have to take calculated risk. And that is the only way you can have proper risk management and grow your account significantly. I hope you got huge value from this video. If you do, let me know in the comments below, and also drop in the comment section your questions. If you got any questions and want me to attend to, if you want to see more videos like this, smash the subscribe button, and also let me know in the comments your name and where you're watching this video from. Don't forget to give this video a thumbs up. That's really going to help us to reach out to more people. Thank you for watching. My name is 𝗧𝗶𝗺, and I'm always here to help. See you on my next video.
Nothing can stop me, I'm all the way up.